Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Steve Wyett, Chief Investment Strategist at BOK Financial, and Steve Sosnick, Chief Strategist at Interactive Brokers. They join me to discuss the base case for continued growth in the economy, Fed and fiscal policy, and the 6-year anniversary of Volmageddon. Gentlemen, it's great to have you with us. Two Steves, two investment strategists, two Nasdaq-listed companies. I think we have some good stuff coming to us today. Steve Wyett, let's start with you first. Speaking of the base case for growth, the employment numbers this morning, I think that blew everybody away.
Yeah, Jill, this was one of those numbers that I think everybody that was there watching as the report came in just was just like, wow, this is unbelievable to see how much the growth in jobs was. And not just that, we knew January had some revisions coming to it, but the upward revisions to November and December, all of that just added to a labor market that continues to be really strong. There's nothing wrong with that. That's good from an economic growth standpoint. I think the potential fly in the ointment, of course, is we're looking at average hourly earnings up 0.6%. That's been on a little bit of an upward trend over the last 2 or 3 months. That's going to have to give the Fed pause as they think about their monetary policy rate cuts as we move through this year. But Jill, stepping back, thinking about what's happening in the labor market, when the Fed started raising rates in March of 2022, unemployment was at 3.6%. I remember Jay Powell talking about that we needed to be ready for some pain. And I think the pain he was talking about was a little bit higher unemployment. We're at 3.7% after 5.25% of interest rate increases. Just an incredibly resilient performance out of the economy to this point.
Mm-hmm. And Steve Sosnick, does it make the job harder or easier for the Fed? I mean, the headline number, again, was really quite compelling. How did you interpret the report?
Funny, Jill, because someone asked me in the immediate aftermath, like, what does this do for the Goldilocks scenario? And my response was, the jobs porridge was way too hot. So I think what it does for the Fed is it takes the idea of rate cuts off the table, and we're seeing the market, the bond market, certainly readjust to that reality this morning. But from the Fed's point of view, remember that there's the dual mandate, and the dual mandate is full employment and stable prices. This continues to check the box off on full employment, and as Steve mentioned, 5.25 points of hikes haven't really moved the needle on the full employment aspect. The stable prices aspect does come into play when you're talking about relatively hot, wage numbers. But again, this is what I would consider a high quality problem for them. It means they don't really need to do too much. They probably need to watch and wait and make sure that the price pressures don't spill out of the labor market into the broader economy. But otherwise, they don't have to do anything really, and that's what is being repriced into Fed funds futures as we speak.
Mm-hmm. Yeah,
Jill, I think that's exactly right. This is going to put the Fed in a position where this patience that they were trying to talk about in the press conference is fully warranted. And as far as the markets go, as Steve mentioned, the bond market's repricing to closer to what the Fed's been saying: 3 hikes, not 5 cuts, not 5 or 6 cuts, which was always a bit interesting from our standpoint as to what that would mean. But the equity market today, it's like they're pricing in the math of higher rates, which can be a little bit of a negative from a valuation standpoint, but that's reflective of a better economic environment where earnings can stay strong. And we're going to need that if we're going to hit earnings estimates, which are running about 11% for 2024. We're going to need that positive economic growth environment to continue for equities to hit those type of growth numbers.
Yeah. So do you think the move that we're seeing today, is it predicated not because of the jobs numbers, but because of what we're seeing with some quality earning beats? I mean, you can certainly tell the Nasdaq 100, the contribution that Meta is having to the index this afternoon. So do you think it's more of an earnings thing, Steve Sosnick, or is it the combination of the two, strong economy and earnings?
I think, everybody in general, you want to see a strong economy, but the fact that we still had, decliners outpacing advancers the last I looked, tells me that the entire market, the broader market, hasn't really bought into the stronger economy idea. This is both the risk and the reward of concentration in a very narrow list of names. When you have one of them going up 20%, another going up like 7%, that's going to pull the market along in its wake. And that's kind of what we're seeing. At one point earlier today, when I looked at NDX and how much it was up, and I did the math, and it was essentially it was Meta. You figure Amazon and Apple sort of canceled each other out, and so this is where you can have a situation where the dependence on a small list of stocks, if they're going in the right direction, it can really help you. Goodness knows, let's see what happens. I don't want to know what happens if that pattern changes.
Yeah. Well, Steve, let's think about this for a moment here. If we're only going to get 3-4 rate cuts, let's call it that, we don't get the 6 that the market anticipated. We certainly saw how much it anticipated, towards the end of 2023. I mean, everything went up at that time. If it signals the economy is doing well, employment strong, consumer spend is strong, inflation is somewhat under control, how does that bode in terms of the expense of capital in terms of the housing market? If we're not getting those rate cuts, things are still expensive in terms of cost of capital. Does that balance it out at all?
Well, it does. Look, I mean, I think that's one of the things that's been surprising to us, certainly as we move through 2023, is that the increased cost of capital did not have a bigger impact on economic growth. It was, you would just have thought historically, as the cost of capital increased that quickly and by that amount, that we would see that impact on the economy. Now, we do think that the longer rates stay higher, the more that we're going to see this impact. Maybe the performance of well-managed companies versus poorly managed companies starts to broaden a little bit, maybe getting back to that concentration of the performance in the index, which along those lines, my goodness, Meta up 20%. That's $200 billion in market cap in a single day. But that notwithstanding, it's the higher cost of capital is going to have an impact as we move forward. The offset to that, though, Jill, and I think this has been kind of important for a lot of consumers who, as rates were low, really turned out a lot of their debt, their mortgage debt, and all of that stuff. Higher interest rates have had a positive impact on savers and their ability to earn interest. And we've certainly seen that in the big companies, the S&P 500 companies, where net interest expense for 2023 actually went down because they had more cash than they did debt maturing. So, it's this convoluted kind of mix of things going on out there. But clearly, higher interest rates, the longer you have them, are going to have an impact on what's happening in the economy. As far as housing goes, just quickly on that, because you mentioned that, I'm not sure, look, Fed policy has some indirect impact there. But I got to tell you, as we look at the housing market, which has been one of the more confounding areas of the economy, this is a supply issue. It's not a demand issue. There's lots of demand, in fact, almost too much demand for housing. But this is a supply issue. And man, the solution to that is going to be multifaceted. A lot of that's around local regulations and policies about what can be built and where. So it's going to take a while for the housing market. My sense is if mortgage rates go down, you're just going to see a bigger pool of qualified buyers. And that's probably going to have the impact of pushing prices higher, not necessarily improving affordability.
Yeah, and that really is it at the end of the day, is the affordability crisis, certainly in the U.S. Let's shift gears for a moment, Steve Sosnick, get back into equities for a moment here. If you think about it, and we were talking about concentration risk, 5 of the Mag 7s reported this week. That was like $10 trillion in market cap, just reporting in itself. But perhaps could also be a stock pickers market as well, especially if we're in this interest rate higher for longer scenario.
Absolutely. And I think we're very much in a stock pickers market. I tend to look, correlation and dispersion for things of that nature. And actually, quite honestly, there's a few stocks that are really driving the bus, and everything else is just sort of scattering in different directions. So that does really help a stock pickers market. I think what was very interesting was the difference in reactions between the 2 that came out on Tuesday and the 3 that came out yesterday, Thursday. Whereas, in the case, in all these stocks, they actually all basically did beat their top and bottom line numbers. But when you're priced for perfection, you better deliver it. So in the case of Microsoft, they beat on the top and bottom, but then people poked through the numbers and said, oh, maybe there's a problem with Azure that we're not seeing. And so the stock didn't really rally. With Google, Alphabet, the search engine business was they missed by like, I think it was 48 billion was what they reported, and 48.16 was what they were expecting. And all of a sudden, that's problems with the advertising search business. Let's take the stock down 6%. So this is what happens when you're priced for perfection. Apple, same thing. You beat top and bottom line, but let's look for problems in China and take it down. Amazon, they couldn't find anything, and Meta, of course, there was, it was impossible to find anything. So basically, you have, that's what you're seeing today. And if you're picking the right stocks, it's phenomenal. But it definitely leads to a lot of FOMO. And I've used the term weaponized FOMO to refer to the recent rally. And I do think this reinforces that concept when you see, a handful of stocks really outperforming.
And Steve, why you look like you have a follow-up there?
Yeah, no, I think Steve's right on point there. I mean, it's the whisper numbers were a little bit stronger, and when you've moved as far as these companies have moved, you've got a hair trigger finger on when it's time to pull and say this thing's done for now. You can always come back to these stocks. So I think that down 6% is it's not the end of the upward move in Apple, and so it just gives people a reason to maybe reconsider and think about when they want to come back into it. But these companies continue to perform really well, and there was nothing wrong with their earnings as we ended the year.
I think it's instructive to remember what happened to Nvidia after its last earnings report, right? The stock beat on every metric, and then it sold off anyway, and had, obviously it didn't really put a dent in its prospects because the stock's up about another $100 since then. So, again, we'll talk about Nvidia, I'm sure, when that time comes in a couple of weeks. But that's really what's going on right now is, the market you've got to be perfect right now. If you're priced for perfection, you've got to be perfect. And if you don't deliver, that's going to punish you in the short term. But then can investors reassess and move higher? And certainly there's opportunities for them to do so. But it does concern me that this ever increasing need for perfection in a small group of stocks definitely raises the risk profile as you get into events.
And Steve Sosnick, stay with me for a moment here, because Monday, February 5th is the 6-year anniversary of Volmageddon. I live with a trader. I remember that day and night very well. Explain to us how it's different in terms of volatility then than now. And then Steve Wyett, if you could follow up and give us how different the economic and macro picture is then versus now.
Well, I was an option market maker at that time, and it was a very, very difficult day. Now, some of the things to keep in mind: we are seeing a big popularity in volatility selling strategies, but it's done more systematically. A lot of ETFs and funds that are doing it. Whereas at that point, it was sort of everybody. I remember another strategist who's done options for years who I talked to, and he was like, I said, this is insane with VIX getting down towards single digits. He's like, oh no, it can go even lower. I'm like, it just mathematically, it's just almost impossible. And when I started to hear things like that, but so we're not nearly as extreme. When we're talking about, somewhere in the 12 to 14 range for VIX, it's historically low, but not in the same realm. Also, at the time, you had equity traded products. A lot of, there were some ETNs, which is a product that I don't particularly love because it's got all the risks of an ETF, but with extra credit risk thrown on top of it, that got themselves into real trouble in terms of being short volatility in those days, and they literally blew up. And I don't see that potential to blow up. One of the things that became popular, because by the way, today is also literally the 1-year anniversary of what I call the debutante ball for zero dated options, because you had the same sort of setup a year ago where you had a Wednesday Fed meeting and a Friday jobs number, and people realized, wait, I can buy options on Thursday. This is that expire Thursday. This is great. And there was a lot of hand wringing then about that bringing on another Volmageddon type of idea. But my feeling there is, while that's different now than then, it's really just, the term I used, and I know you work for an exchange, is going to get people very angry there, is that the casino, the games haven't changed. The casino just opened more tables. And really there's nothing fundamentally different about zero dated options. We've always had zero dated options. It's just how many expirations we pack them into. So those are the differences and similarities. History rhymes; it doesn't repeat. But I think it's not really. We don't have the same sort of setup right now. The risk tends to come again more from concentration in a few stocks. Maybe you can get a little more micro bursts of volatility from people piling in on zero dated options, but speculators tend to speculate from the long side, not the short side, and so I don't think you really. While we get some melt ups, I don't think they really contribute as much to melt downs. That's my take, at least as of now.
Yeah, and I think from just if you look at the macroeconomic environment, it's relatively. This is a dangerous word to use. It's relatively sanguine as we look at what's going on out there. The risks of a recession just look like they continue to come down. The consumer is going to remain supportive of the economy. We see some cracks around the edges around credit quality, or maybe some increasing delinquencies on credit cards. But if you step back and look at longer term charts, we're way better than we were like as we get back towards the financial crisis. So these are, it's all relative. It's we have some things in the economy we can kind of grind over, and maybe that's just because as economists we're kind of paid to think about what can go wrong. And clearly, I think at this point, the big things that can go wrong are probably completely outside of our control. I'm just talking about hot geopolitical and potential activities that are impossible to forecast and tend to be kind of binary. They either matter or they don't. And so I think that just as we think about the macro environment moving forward, you're just looking at an environment where companies are going to have the ability to make money. I'm like Steve, that the concentration of the performance, many of us put together charts that showed the concentration of the top 10 stocks in 2023 versus history. It was very high. Previous periods of concentration haven't unwound particularly well. But I think that for many of us, when we think about coming through the pandemic and the actions that we took, both from a monetary and a fiscal standpoint, we never did some of that stuff either. So in some ways, I look at how the economy's acting and the fact that it's maybe different than what we would have anticipated. That's probably right, just because we did some different things coming through the pandemic than we've ever done before. So it's not surprising that the unwind might be a little bit different than what we've experienced.
All right, Steve, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.